Anyone who's been out shopping for a home lately, or even in the last year or two, knows how challenging it is not just to find a good property that fits all your criteria, but also to compete with all the other buyers out there when a desirable house does come on the market. It becomes extremely frustrating, quite frankly, demoralizing to lose house after house after presenting what would seem to be a very fair, if not more than fair offer. After experiencing the disappointment of losing enough properties to other buyers and finally coming to the realization of what it takes to win, buyers will start to look for ways to become more aggressive with their offers. And one potential option is to waive the appraisal, or if not waive it completely, to at least promise to pay a certain amount over the appraised value should it come in low. Now, not everyone has that flexibility depending on their cash situation and loan type, but some do and try to leverage that strength to their advantage, realizing that appraised values are often a lagging indicator of true market values as prices continue to escalate. As buyers mull over their options, I often get the question, how would this affect me? To answer this question, it's important to start with the fact that lenders use the lower of value or sales price to determine how much they will lend against that property. That means if it appraises high, we simply use the price, so it really doesn't help you. But if it appraises low, we have to use that lower value to calculate the maximum loan amount. This is different from refinancing, by the way, where we use current value, unless you bought the property very recently, possibly. So again, the question becomes, how would a lower value affect me? And again, as so often is the case, the answer is, it depends. Keep in mind, first of all, that you can choose to overpay for a property if you like, and the lender will be fine with that. It's just that we will want to limit our loan amount based on that lower value is all. Now, some loans, like government loans, for example, will not allow a buyer to waive the appraisal contingency. And although they have the right to pay more if they want to, are assured the option to walk away if it doesn't appraise, unless the seller lowers the price to meet that value. With conventional loans, however, the buyer can waive the appraisal or, as I mentioned before, promise to pay a certain amount above a lower value if they so choose. A complete waiver leaves an open-ended risk because theoretically there is no bottom to what the value will come in at, and the buyer has to pay the difference. Although realistically, a home buyer and their realtor can do their homework to come up with a pretty reliable, range of possibilities and a worst-case scenario within reason. The hybrid option between the two extremes of a complete waiver versus no waiver at all is to offer a certain amount above a lower appraised value, not to exceed the original contract sales price, which allows the buyer to contain and manage the risk to something within their financial means to fulfill. With government loans, the buyers are typically leveraging up to the maximum loan amount based on value, and anything short of that would simply be a comparable reduction in loan, and therefore would increase their out-of-pocket. So for example, if the value came in $5,000 low, the buyer essentially has to put that additional amount down out of pocket. Although technically they would have put 3%, 3.5%, say, down out of that additional amount anyway. So it's not a complete 100% dollar for dollar translation. Essentially, with respect to conventional loans, though, we look at your down payment typically in increments of 5%. So 5% down, 10%, 15, 20 or more. And the bottom line is that if your appraisal comes in low, we are simply going to look at the loan amount versus that lower value and make sure you're putting that minimum amount down for the program. And then price the loan both in terms of rate and mortgage insurance based on that lower equity position, even if you're actually putting more money down overall. For example, if you're putting 10% down, but the value comes in 5% lower and you agree to pay the same price, then we basically treat that as a 5% down payment and price it accordingly. Worst case, you can still buy the property with the same amount of money out of your pocket, but your pricing in terms of rate and certainly the mortgage insurance would likely increase. And the same logic applies, for example, if you were putting 20% down and thinking you were getting out of mortgage insurance completely, but the value came in 10% low. You could consider putting the additional amount to maintain that 20% cushion, provided you have the funds available, or you could simply leave it as is, and we would treat it as a 90% loan to value or 10% down in terms of the rate, and then you would need mortgage insurance. So it's doable, but could cost you a little. Now, for those buyers who are barely scrounging the minimum down payment as it is, they wouldn't have the flexibility to come up with a difference. So it could become a deal killer if the seller won't lower the price to match the value, or possibly meet somewhere in between. And that's also why sellers like to see larger down payments from their buyers, because it lowers their risk in terms of a low appraisal at these escalated prices. This is the type of detailed analysis that buyers and their realtors and loan officers need to do when they're strategizing about making an offer and possibly waiving the appraisal or offering to pay a certain amount above a low value, weighing in their financial resources and the risks associated with the various options available. Again, it is critical that buyers have trusted and knowledgeable mortgage professionals and realtors to help them navigate these decisions and advise them accordingly. So I hope this has been of interest. And as always, please feel free to reach out to me anytime I can be of service. Have a great day.